we've got Blackstone and now a bunch of other firms focusing on a new kind of financing vehicle called debt, convertible debt, debt with warrant coverage. Here comes the debt. Blackstone, not to be confused with BlackRock, which I'm going to talk about in a second, announcing $2 billion plus lending push. I don't know where this $2 billion number came from, but they have literally over $20 billion in their global private credit fund vehicles. Maybe they're allocating at least $2 billion of that just to go into tech investing. But they're basically looking for, I would call pre-IPO and late stage startups doing at least 30 to 50 million in ARR, which is annual recurring revenue. You typically see a SaaS startup, software as a service, has that ARR revenue model. Marketplaces generally have a take rate. They're taking a portion of GMV, gross merchandise volume. So, that ARR is very predictable, right? I have subscriptions. You can see people paying on time. It's kind of hard for that money just to dry up and disappear. Maybe you don't grow as fast, but hard for that business to go to zero. But it's still possible. So now with the IPO market in just complete disarray, these later stage startups saying, well, I can't exit and go public. If I was to raise a priced round, which means to sell equity to investors to raise capital, that's going to be very dilutive because the valuations are taking, massive haircuts from where they were 6-8 months ago. And so what do you want to do? Hey, I want to use a source of capital, which is less dilutive if I'm the founder and an employee that owns options and certainly investors that already own shares. Enter debt, and debt mixed with equity, convertible notes, bunch of different ways to structure this stuff. But in the way this stuff works is that debt, in the event of a liquidity event, the creditors, the debt holders get paid back first, and then the equity holders get paid back after the debt. And then there's basically a tiering system of where you sit on the cap table and who gets paid off first, who has more leverage or less leverage. Preferred equity sits above common and all these kinds of tierings. But anyway, so now you got Blackstone putting a bunch of money into this, trying to compete with other players that do this. Like Silver Lake has been doing this, did this a few times during kind of 2020 COVID panic era, which I'm going to talk about here in a second. Silicon Valley Bank has been doing this for ages. Let's look at an example about how this played out. Oh, remember Airbnb in April of 2020? Airbnb raised $1 billion of debt and then another $1 billion of debt 2 weeks later. Both of those are debt deals. Both of those deals show, again, how this stuff can work. So the second $1 billion that Airbnb raised, they actually paid a lower interest rate than the first $1 billion. The first $1 billion that they raised was at 11.5%. Silver Lake, Sixth Street Partners put that deal together. And so that debt was treated in the second position. It wasn't in first position, which is basically you get paid out first in the event of a default. But then they also had an equity component of it. Typically you get some warrant coverage. Warren Buffett did this with Goldman infamously. Guy killed it on this deal. Buffett invests $5 billion in Goldman. This was during peak mania in 2008. $5 billion in Goldman Sachs. People were like, oh my God, is Goldman Sachs going to go bankrupt? Oh, Warren Buffett just gave him $5 billion. They're going to be okay. Berkshire bought $5 billion of preferred stock. It has a 10% dividend. It's not debt. Now this is preferred equity. It has a dividend. Kind of looks like debt, but it's not debt from a cap table standpoint. And then they get warrants where they can buy $5 billion of common stock at $115 a share within 5 years. Today, Goldman stock is at $350. In 2008, the shares went down to as low as $70 for, a couple days. But then, within 5 years, they got up to 175, $150 a share. That's just free money, right? That's on top of, hey, they bought equity and they get a 10% return on the equity. Then they said, hey, here's another $5 billion of warrant coverage. And you don't have to buy those warrants at $115 a share unless you're in the money. So if the stock's at 175 or 150, boom, execute. You just made another $1.5 billion. You can see how these debt equity deals can be very lucrative when done properly. So that was the first deal that Airbnb did. First deal Airbnb did was $1 billion. It was a hybrid debt equity deal. In the second position, 11.5% interest on the debt. Then 2 weeks later, they did another $1 billion, which was lower interest, 9%, and that debt was in the first position. Silver Lake was in that, Sixth Street was in that, and I think BlackRock might have led that. BlackRock was in it, Fidelity was in it, all these big guys. Owl Rock did another deal in 2020 with DoorDash, $340 million convertible debt deal in 2020. These are great deals. These deals make sense. If you're a later stage startup, yeah, you should absolutely be looking at doing this stuff. And the firms that are out in front of us that have the experience, that know how to structure these things properly, deals will do pretty well. If you like that video, go check out our videos from right when COVID hit, March, April, May, looking at tech startup valuation and platforms and how they were faring vis-a-vis the rest of the market. Those were pretty interesting times to kind of go in the Wayback Time Machine on.